So I'm head of investment banking for D.A. Davidson. We're a 76-year-old investment bank, 66 offices in 17 states, including Seattle. We have a big office here. We have about $28 billion in assets under management. I'm a member of the public equity, private equity, and fairness opinion committees. This cord got a little stuck. And prior to Davidson, I worked for 20 years in New York on Wall Street for JP Morgan, KeyBank, and Broadview, which is Jefferies. We do a lot of M&A, private placements, public offerings, and fairness opinions. Some of my clients in the past have been AT&T, Cadbury Schweppes, GE, IBM, Toyota, Verizon. You've heard of some of these companies. I'm a former board member of Thinking Machines, which was a pioneer in parallel processing, so I do know tech. And I think OVP Ventures, you know of them up here. I was on their finance committee, or valuation committee. And I speak at a lot of conferences. The firm I'm at, here's a good example. We're a national firm. We have investment banking. We're full service, so we have research, sales, and trading. That way we can take companies public. We also have brokers, and we have fixed income, which is a Wall Street term for bonds. We have muni finance, and then we manage assets. On investment banking, we do a lot of M&A, private company sale, public company sale, divestitures, buy side, I'll talk about that later, leverage recaps. We love public equity. We did about 16 public equity offerings last year. We led 5, and some of these are on the sheet. I mean, we led 160 million IPO. That's the type of business firms in New York would love to have. And we do secondary offerings, and we do converts. We like private placements of equity and debt. And then on advisory, we do fairness opinions, valuations, but we also will set up poison pills for companies. We get that. Shareholder rights plans. We'll do proxy battles, things like that. We are, I hate to use the word dominant, but we are. We're the dominant investment bank in the Northwest by a mile. I'm not going to go through all the statistics, but we do 30 to 40 deals a year, and there's no one else in this area who does that amount. We do a lot in the Seattle region. I'll talk about some of these deals later, and no, that's it. So that'll do bio. So let's go back to the presentation. Is that helpful at all? Sort of helpful? Okay. I'm sorry? Well, a lot of our bankers are industry focused. My industry is tech and telecom. I've got a 25-year background in tech and telecom, but as head of the group now, what's happened is when I was working in New York, I focused on industry, but now that I'm out here, there's actually not a lot of bankers in the Northwest. And so I get pulled onto other deals. So for example, I just want to get this unstuck. I sold Tully's Coffee's wholesale business to Green Mountain. That would be coffee. And I sold, we'll talk about later, Screen Life, which is that scenic game, to Viacom. Well, I guess I'll call that digital media. But I do other deals too. But I love tech and telecom, and I've done a number of tech and telecom deals up here. Let's start with capital market trends. Well, the U.S. indices have been in a bull market for 24 months. S&P 500 and NASDAQ are up 100% and 126%, which is not bad since hitting their 12-year lows in March 2009. Of course, how numbers work, if you fall 60%, if you go back up 100, you're not there yet, and I'll talk about that. Markets are being driven by strong corporate profits, continued optimism of a global recovery, and really QE2. QE2, as you know, is the Fed's bond buying activity. And what they're basically doing with QE2, and it's going to end soon, is they're buying back bonds in the market in order to depress interest rates. And if you make bonds less attractive, then people will gravitate to riskier assets like real estate and stock, and that's what the Fed's wanted to do. On the other hand, they've injected so many dollars into the system and made the dollar so weak we have inflation, which you've seen at the gas pump and in the grocery store. So it's a very controversial thing. With the unrest in the Middle East, which there was a story, of course, yesterday and today, high commodity prices, and the budget stalemate, there is a lot of worry on Wall Street right now. But the market seems to be fluctuating between these growing uncertainties and resilience. So it's up a little, it's down a little. But if you look at it, since its '09 low, it's come up a lot. And year to date, it's done quite well. So just some more trends in capital markets. 2010 was a very good year. The public markets were up very much. Middle market M&A was up. I'm going to have a long discussion about that. IPOs grew by 110% in 2010, up from 60, going from 60 in '09 to 126 in '10. Follow-on offerings declined, but I'll discuss why IPOs went up and follow-ons declined. It's partly because what happened in '09 was a lot of banks had to refinance out TARP, and so there were, and I'll show you the statistics, there were huge public offerings in 2009, secondary offerings. These are follow-on offerings for public companies, and so the statistics are a little skewed because of that. Now in 2011, S&P and NASDAQ are already up 7% this year. I think for some of the reasons I discussed, including QE2. Middle market M&As continued its strong rebound. Public markets are generally receptive to offerings right now, and we'll talk about that. And public companies have a lot of cash, and buyout firms have a lot of cash. We'll talk about how that affects the M&A market. So that's the capital markets overview. Let's talk about M&A. Let's see if I can. Well, I'll do it over here because I'm tethered to this thing. Middle market M&A dollar volume grew 44% over the past year, from 102 billion to 147 billion. Now that's 2009 to 2010. In Q1 2011, transactions are down slightly, but if you look at the graph, you'll see that dollar volume increased from 31 to 36, so it's still a healthy market. It's the sixth straight period of year-over-year quarterly volume growth. And now let's look at valuations. If you have growth in deals, you normally have a growth in valuations, and you do have that growth. What you'll see is exit multiples expanding. Go to Q1 2009, and you'll see how it dipped to 5 times EBITDA and then steadily grown. And it's kind of established a nice range in here between 7.5 and 7.8 times. This is EBITDA. Does everyone know what EBITDA is? That's an M&A proxy. It's a cash flow proxy. The M&A people use it a lot. It's actually a nice way to value the company. It's a very deceptive data point because, as the telecom people found out in 2000, they financed their companies based on EBITDA. They went to the commercial banks and said, my operating income plus my depreciation is $100 million or $1 billion, lend me a lot of money, and the banks forgot about CapEx. So it is, I mean, the flip side of depreciation is CapEx, but the reason why we use EBITDA as a proxy is if everyone's using it, you have to use kind of the market standard. Okay. So a lot of times when I give these speeches, people say, okay, well, that's the country. How is our region doing? So we ran some numbers for California, Washington, and Oregon. California is just the monster in number of deals and size of deals, but Washington does a lot of deals. 2009 Q2 wasn't too strong for Washington, but that was the recession. But Washington has very healthy M&A versus a lot of states other than California and some of the really big states. Oregon's kind of a laggard, but bigger than other states. Oregon's kind of like Utah in these deals. Washington's bigger, but California's where a lot of the deals are. Let's talk about private equity in the buyout industry, because the private equity, the amount of capital raised in private equity and what's going on in private equity really matters to M&A. In the old days, especially in tech, and well, old days, there's really old days and then there's middle old days. But say we go back to 1999. You're an M&A guy, you're selling a tech company. You're going to get a lot of bids from strategic companies. You're not going to get many bids from private equity firms, because the traditional private equity firm makes their money by loading debt on these companies. You can't put debt on a semiconductor company. Well, times changed, and I'll talk to you about that. The private equity firms raised so much capital that you started seeing LBOs of semiconductor companies, which are mostly bad LBOs, but they were going after anything that wasn't nailed down. And in 2006 and 2007, even if I'm selling a software company, if I'm selling a software company in the market, I'm probably getting 2 or 3 bids from strategic buyers and 15 bids from private equity buyers. It was a tsunami of buyers, which was a great time. So let's talk about, they're going to spend money if they can raise the money. And I'm going to move this up here. So buyout firms raised unprecedented levels of capital in 2007 and 2008. Fundraising started to lag in 2009 and 2010, but I'm going to talk to you about this. When you see these levels of private equity, you're going to get an overhang. So let's see if that occurs, and it did. So let's talk about the private equity overhang. So in 2007, they're raising $130 billion of equity, then they raised more. Let me tell you what these numbers are. These numbers, we had numbers that showed how much they raised before. And I took that slide out because how much they raised is somewhat irrelevant. What you want to know is how much they raised minus how much they spent. So in 2008, the difference between how much the private equity firms raised and spent was $155 billion. What this is all translating to is there's about $490 billion of private equity money out there that hasn't been spent. If you lever that up 2 to 1 or sometimes 3 to 1, you can have close to $1 trillion or more of private equity money looking to buy companies. That is a lot of money, okay? And that's why I wanted to show you this overhang. This is going to be a function of debt, and I'm going to talk about debt, but there's a lot of private equity money out there. And for example, Greg and I just sold a tech company in Seattle 2 months ago, Greg, 3, to a private equity firm. And I'll talk about that deal. Actually, I sold 2 tech companies in Seattle in the last 2 months to private equity firms. But that's just as part of this market. So you need to understand the private equity market to be an M&A professional. As I said, in the old days, if you're selling a database company, you went to Sybase and Oracle and Informix, if I'm correct, and Microsoft later. But you had certain people you went to. But now, if you're selling a company, you have to know the private equity firms, because you're going to get private equity firms buying tech companies. So buyout fund deal volume. So if you look at 2007, you'll see that the number of buyouts increased. Well, the number of buyouts increased in 2010, 2008, 2009 I'll talk about. But 2007 was a very good year to sell companies. You had the strategics bidding, you had the buyout firms bidding, and you had $597 billion of private equity buying in the market. It was very nice. Private equity funding by rounds. So we wanted to just take a look at how the recession affected the private equity buyers. And so what we did is we looked at this and said that how are they investing in terms of first-time PE financing versus previous PE financing. And previous PE means a company was either bought by a private equity firm before or they had an investment by a PE firm. And what you'll see is that there was kind of a flight to quality in 2009 and 10 where the buyout firms basically said, I don't want to invest or buy firms that don't have an institution around. I want to invest in firms that have already been vetted by institutions. And that's what you would expect would happen in a recession, and that's exactly what happened. Okay, private equity exits. The main exit route actually for private equity firms is to sell companies to corporate buyers. The reason is that traditionally, private equity firms do not like to buy companies owned by private equity firms. And when I explain that to people, they go, why? Because private equity firms will go to their limited partners and say, we're really smart guys. What we're going to do is we're going to go to an inefficient market and find companies that need kind of cleaning up, that don't maybe have the best management team or need cleaning up. And that's why you should give me millions or billions of dollars, because I'll find those companies. And I'll replace management, or I'll clean it up, or I'll do something because I'm so smart. And what happened is you got to a certain period, which you'll see on this chart, where instead of buying companies that had never had a private equity round, they started trading baseball cards among themselves, is what I call. So you started seeing a lot of private equity firms buying companies from other private equity firms. And I've talked to a lot of those guys about that, and I go, what are you doing? And they always have an explanation. But technically, if you bought a company and you already cleaned it up and you already replaced the management, and you're a private equity firm and all you're doing is auctioning that company, why should another private equity firm come in? It's already cleaned up. There's no reason. The only reason you do it is if you're selling a company to her and she's selling to him and he's selling back to you, and then you go to the LPs and say, I got exits, I want to raise more money. And that's what was going on. You can see it on this chart in terms of the increase in sales to private equity firms, and that phenomenon just occurred in this year. Lending environment. One of the things that drives M&A and the private equity is lending. And as you see, let's see on the chart. So let's go to 2009. 2009 was a crisis among the banks. And so the banks were lending towards deals about 3.3 times EBITDA. Why does that matter? Because if the private equity firm or any buyer is going to put in 1 to 2 times EBITDA, then you can see in 2007 why they were paying such high multiples, because they could borrow 5.6 times. And the banks were lending a lot, and it wasn't just senior debt, which was at 4 times in 2007. It was also mezzanine debt, and you were getting hedge funds coming in the space and doing things called second lien loans, which didn't make a lot of sense, because if you know securitization, not securities law, the assets are already secured by lender one, and they were coming in and lending in a secondary position with a second lien on assets that were already liened. It was that would be a frothy market. And so the leverage ratios were high. There were a lot of people buying companies. In 2009, the leverage was low and banks were lending. And so you had a dip in the market. I think the last slide I'm going to talk about, 2 more on private equity. We have companies that will come to us and they'll say, well, I heard $1 billion company was sold at 8 or 9 times EBITDA. I have $5 million of revenue. Can I be sold at 8 or 9 times EBITDA? And obviously, you look at the growth of the company, you look at the profitability, but in M&A, I'll use this term, size matters. And the bigger companies just get bigger multiples, and there's many reasons. One is they may have dominance. Technically, if you're a bigger company, you may have better distribution channels, or you may be an international company. But the other thing that happens is the lenders will lend. So if you look at 2009, if you're a company and it's a $250 million or below deal, the best you're getting is 46% loan on the deal, meaning 64% has to come elsewhere. And if you're a big company in those days, you're getting 62%. Now, that's a function of it's a skittish market. So in a skittish market, there will be a flight to quality, and people will gravitate more towards the bigger companies. But for someone like me looking at that chart and seeing the difference in lending for big companies and small companies, I can tell you right now, this company is going to get a higher multiple when they sell the company, because you have 62% of other people's money going in. Okay? The last chart I have on this is just private equity deal structure. The old structure, now we'll say old 4 years ago, would be that you'd get bank debt of about 50%. Mezzanine debt of about 20%. Mezzanine is a different type of lender. I guess I have to describe what that is. That's a type of security that sits between the senior debt and the equity. It's going to have a higher coupon. There'll probably be warrants attached, and it just gets a higher return. Here would be an example, although it's all across the board. The equity guy may want 20 to 30% return, and the senior debt guy, I don't know, it depends what they're lending at. We'll call it 6 to 8%. And so the mezzanine guy is probably going to be in there at about 15 to 20%, sometimes up to 22%. And how do they get there? They may have a security which pays 10 to 14% interest, and then warrants getting you to the rest. And the reason you do that is because the senior lenders just won't, they're capped out at a certain amount. Remember, if you go back to this chart, yes, you'll see how the senior lenders capped out in 2010 at 3.2 times. So if you want to borrow 4.1, you're going to need that mezzanine piece. Okay? So the older structure would be bank debt about 50%, mezzanine 20%, and equity about 30%. The new structure, especially during the recession, is the buyer comes in and they have to put in more equity. The real issue is the bank debt. It's how do you fill in? Now the bank senior lender is saying, I'm not funding 50%, I'm funding 25%. And they may say, I'm only going to lend against the assets, okay, which would be an asset-backed loan. I'm not going to lend against cash flow. So now they're at 25. Well, you got to make that up somehow. So the buyer is saying, okay, I'll go from 30 to 40%. You might say, well, why don't you just fill in with equity? Well, equity at 75%, he might not get the return he wants. He might not get that 30%. So now the equity guy is saying, okay, well, what the equity guy first does is he gets as much bank debt as he can. He's only getting 25. Now he goes to the mezz guy who used to get 20, and they're only at 15. So he's got to fill that in. And he's not going to do, he or she is not going to do 60%. It's just a deal thing. So what's happening a lot is you're getting into a lot of seller paper. And we've done a lot of deals recently with seller paper. Seller paper is basically the seller is the lender. And I will have clients who will say to me, I don't really want seller paper. And I'll say, why? And they'll go, well, because I really don't want it. And I'll say, okay, why? And they'll say, can you tell me what it means? I'll go, okay. And I'll say, well, there's some advantages. One advantage to seller paper is, think about it. You own a company that's worth $100 million. You cash out. You take that money. Are you going to put in the bank and get 1%? I mean, where are you putting that money? What I'll say to sellers is, hey, you love the company. You're going to stay working at the company. And why not do the seller paper and invest in the company? And what will happen is, okay, you're not going to get what the mezz guy gets at 14 to 20, but maybe we can get you, unfortunately, I'll always say 10 or 11, we get 6 to 8, but maybe I can get you 7 to 8% on your money. Well, that's not so bad. Okay, that's number one. Number two, it's almost always a bullet payment. And you're only taxed on that when you get the bullet payment, which is very nice. So you may have clients who the buyer is saying, the only way I can get you to there is with seller paper, and you can say to the client, well, it may be a nice place to invest. You are sitting above the equity, so you have more security, and you're only taxed on that when you get the principal back. Well, obviously you're taxed on the interest every year, but you can defer that chunk, and people like deferral. You're earning money, and you have that tax deferral. The issue becomes, though, is that what the buyers do is they put the bank debt up here and the mezz there, and a lot of the seller paper is below the mezzanine, which sellers, if they're smart, don't like it, and then they're paid less than the mezzanine. But what I did with the last seller is I said, okay, but it's 20% of the deal, and if you want $100 million, you get paid $20 million more. Now do you like seller paper? And he goes, Yeah, I like seller paper then. So, but it's a big deal now. Almost all of the deals with the private equity is involving seller paper. As I said again, what you say to the guy is if you got a client, you say, I'm not telling you to take it, but we say is, A, you're going to get a higher purchase price for your company. It's not a bad place to invest your money, and there's tax advantages to it. The whole issue for you, if you're advising the company, your lawyer, is just make sure that that thing is treated like debt. The buyer will try and push it as far down the capital structure as they can and pay as little money as they can on it. Just make sure it's treated like debt. It has preference over the equity. It's getting a good return. Greg, would you agree with that? Okay. Okay. Let's talk about public equity. Let's see how I'm doing. I'm doing pretty well. I wanted to talk a lot about private equity to you because the problem is if I go to an industry forum and they say only talk about technology, the weird thing is my whole presentation is corporate acquirers, because I can tell you what that corporate acquirer will do. But when you're at a generic M&A thing like this, the corporate buyers are all different. For example, people will say to me, well, what will a corporate buyer pay as a multiple of EBITDA? And I'll say, what industry? And they'll go, well, just what will they pay? Well, banks pay as a multiple of book value. So, I mean, does that matter to a tech company? They pay as a multiple of book value. The tech guy may pay as a multiple of revenue. The manufacturing guy may pay as a multiple of EBITDA. So it's just a different thing. And so that's why I want to spend a little time with you on the private equity, which is defining a lot of this market. Okay. Let's talk about public offerings, because your clients or whoever you work with, this is a legitimate alternative to M&A. Actually, I want to explain the investment banking industry for a second too. The investment banking industry has morphed into 3 tiers now. There's the JP Morgans where I worked, and the Morgan Stanleys and the Goldman Sachs in New York. And they will do public equity, they do M&A, and they do private placements, and they're all around the world. But if you're selling a company or working with a company below $1 billion, they're not really for you. They just, I know, I work there. They want to work on selling Chrysler to Toyota. They don't want to work on selling a company in Seattle to, for 20 or 30 million. That's just not their business. The low end, you have a lot of M&A boutiques. And the issue with them is A, a lot of them aren't licensed, which is a big issue, because buyers can rescind if the M&A advisor is not licensed. And there are M&A advisors in Oregon and Washington who are not licensed. If you're an attorney, you really got to watch that, because you'll get a guy who's coming in a bank saying they want to advise your client to sell them, and they may not be licensed. And as I said, the buyers can rescind the deal, and that's not good for the lawyer, and that's not good for the accountant, and that's not good for the company. But the other issue with the pure M&A boutiques are they have one product. So you have a nice company, and they come to you and they say, oh, you have a nice company, sell yourself. And you go, well, I don't want to sell, or I may not want to sell. And they go, well, that's all I do. I sell companies. Sell yourself. The benefit we have as a full service firm, we're in the middle, is I come to you and I say, you have a nice company, maybe you should go public. Well, you want to hear about that. Plus, we have research and sales and trading. So you're a semiconductor company, or you're a communications semiconductor, we cover Qualcomm. Or you're a food company, we cover Sara Lee. We trade those securities. We know how they're valued. We're trading in the market every day companies in your industry. We have research that covers companies like that. So we have in-depth knowledge of valuations and buyers and things like that. And I legitimately could take your company public. Or I might say to you, no, you're not ready to go public yet, but we can raise you 10 or 20 million of private equity or debt to grow. Okay? That's an alternative. Or we can value your company. Or we can help you buy his company. Or we can sell you. And it's just, that's one of the reasons I'm at a full service firm, because selling your company is not always the best option for a company. And that's why we like to know public equity and what's going on in the public equity markets. Is it not only helps define what's going on in M&A in terms of valuation, because it does. When the market crashes, that affects the M&A market. We just can offer more to our clients. So let's go to the public offering environment. 126 IPOs priced in 2010, up 110% when compared to the 60 IPOs priced in 2009. This is by quarter, so you have to add the quarters to get to that. Since Q3 2008, IPOs have been up every quarter on a year-over-year quarterly basis. So the market is much better. Now, I'm going to talk a little later about what's happened to the IPO market. Yes, 126 IPOs in 2010 is much better than 60. But in 95, when I was taking companies public, you'd do 400 IPOs a year. Now, I don't think when I tell people that the IPO market is much smaller than it used to be, I don't think I'm surprising anyone. And I will talk about why that is. But 126 is, yes, it's better than 60. Then the follow-on offerings, those are offerings after you're public. The market environment for follow-on offerings is very healthy. LTM periods ended Q1 2011, 2010 were up significantly over the same period in 2009. Now we'll talk about that. IPO backlog. The backlog grew substantially in Q3, Q4 09, and Q1, 2, and 3, 10. And you know, if you look at this and you don't really know what's going on, you go, wow, lots of people wanted to go public. What was really going on is there weren't a lot of public offerings. And so the backlog was building. I would look at that and say that that's not necessarily a healthy market, that the queue has just grown. And as you notice, now that we're in a much healthier market, if you look at Q4 2010 and Q1 2011, you all of a sudden see that the backlogs come back to more reasonable terms. Okay. This is actually a pretty important chart if you want to talk about public offerings. Because a lot of times people will come to me and say, Brad, I have a great software company. And I'll say, great. And they'll say, no, it's really, really great. And I'll say, fine, then, not great, fine. And they'll say, I have 10 million in revenue, I'm growing 20% a year, can I go public? And I'll say, that answer I can answer, and that would be no. And they'll say, well, but I heard you can go public in Malaysia or Vietnam or something like that. And I'll say, have at it, no one's going to trade your stock. Actually, I want to talk about the AIM in a second, because people 2 or 3 years ago said, well, what about going public on the London AIM, if you've ever heard of that. So I will talk about that. But let's talk about the US right now. This is a very, very interesting chart, which we developed. Look at 2007, there's 217 IPOs. Remember I told you, I love it when these charts bear out what I say, that while 126 in 2010 is good, it's not great historically. We'll go back to 07, you see, 217.
This is a lazy beam on the thing? Do you want to use that?
Yeah, I would. This will do a little laser. How do I?
There's a black button on there. Try that.
The black?
Right in the middle.
Oh, okay, good. If I can do this.
Yeah.
But I'm blocking, but I can do it this way. Okay, so let's take a look at this. Actually, I like this more, thank you. So, yeah, you can kind of see that. See the 217? So historically, yes, 126 is better than 60. But historically, you're in the 217. Okay. Now, let me show you why this chart's really, really interesting for someone like me. Take a look at 2010. Now, if you look at 2010, you see companies, you see median deal size of 107 million. And 2007, you see 109. So why is 2008, where they aren't doing many deals, the median deal size is 200 million, okay? And then you look at the median market capitalization. It's 414 million. Well, why are they bigger? And then you see deals less than 100 million. It's like nothing, okay? And number of IPOs filed, that's not as important, but let's go down here. Median LTM revenue. Now, this is a healthy market, and guys are going public with 97 million of revenue. 271 here. What's going on? And median EBITDA, 12 million. Now, if you're going public, you need 64 million. And percentage profitable, 53%. You want to go public here, 82%. What is all this saying? This is a classic flight to quality. What it's saying is, even if I didn't know the number of IPOs, I could look at this data and I could tell you the number of IPOs. What it's saying is that in a healthy market, 47% of the companies don't have to be profitable to go public. And you're going public with 97 million of revenue. Now, this is an unhealthy market. You want to go public? You need 270 million of revenue, and 82% of them have to be profitable. And you're seeing the median deal size go from 102 to 200 and 177. So for an IPO guy like me, I don't even have to see the first line. I know the first line. It is classic flight to quality. And this is what really happened. If you want to go public in a recession, 270 million of revenue. Unfortunately, the chart bears it. I hate when I do these charts and they say the opposite of what I want to say, but this thing is really good. This really shows you what happened. But what it also still shows you is the median LTM revenue to go public now is 124 million, and that is really the case. There's a really nice company that I know in, say, Portland, Oregon, that has about 80 or 90 million of revenue software, and they're not getting public. Go ahead.
In 2009, I understand you have to have a different profile for qualifying, if you will, but are there any rewards for those risk takers who do it in a recession, or is it just stupid to do it and you should wait until the market becomes a bit more liquid?
Well, that's a very interesting question. So here's the question. You're in 2009, and it's very hard to go public, or 2008. What's the reward of going public then? Well, first of all, you may need the money. I mean, truly, you may need the money, or you may need to go public for another reason. Tully's Coffee, I did a deal for them up here. They're a publicly traded company because they have 5,000 shareholders. But they're a public reporting company, not publicly traded, sorry. And so as a result, if they were big enough, go public and be publicly traded too. I'm going to talk a little more about that. But to answer you directly, one, you may need the money. You may need to go public for other reasons, like Google. They were getting over the 500 shareholder amount. I don't know if you know that, but once you go over 500 shareholders, you're going to be public reporting. You might as well be publicly traded. That was a big issue, too, with Goldman and Facebook. What Goldman was doing, in my opinion, was basically illegal, and I'm glad the SEC cracked down. They were setting up these partnerships where you got 1,000 guys who are going to be shareholders in the company, and they only count as one. Okay? And they got caught too. Well, the other problem they had with Facebook is they were doing a general solicitation for a private company, which you're not supposed to do anyway. They were doing a private placement with a general solicitation. But back to this. So specifically, you may have to go, but your question is, why would you want to go? And why you would want to go is, especially here, is you get to see all the funds. And why is that important? Companies will come to me all the time, and they'll say, okay, I don't have 124 million of revenue, but I want to go public. I found a guy came to me, he may have had on a check sport coat and check pants, but he came to me and he had a public shell. And he said I could merge into a public shell, this one, or this one, and I merge into this public shell and I'm public. And I will say to those guys, no, that's the wrong way to go public. Why? Because when we take companies public, we take them on a roadshow, and we introduce them to institutional investors. And if we do it right, we take them around the country for 2 weeks. We introduce them to institutions. And then Fidelity, as part of this IPO, they want to buy 20 million of the stock. And we say, nah, you can only have 5 because it's really hot. I got to tell you, right after that thing trades, Fidelity's in there buying. That's how you get stocks popping. And then you have institutions buying and buying and buying, and shares are going up. You have 4 or 5 underwriters on the cover, so they're all providing research, and 4 or 5 market makers. And so if you're an employee of that company, you have a liquid market for your stock. Now, let's say you merge into a shell. You have no research. You have no market makers. No one knows of you. You basically have very little liquidity. What you have is some boiler room operations trying to sell that stock to widows and orphans. The stock isn't trading. You own a lot. Here would be an example. You own a company worth 50 million. We merge you into this public company. Okay? You have 50 million of this stock. You sell 1 million of that in the market, the stock goes from 20 to 5. You can't sell your stock. So you can't sell your stock. Nobody wants that stock. You're what's called an orphan public company. But you still have Sarbanes-Oxley. You still have quarterly reporting. You have all the problems of being a public company and none of the benefits. Okay? So that is an important thing. But back to this question, if you're going out in these years, you're getting to see Fidelity, Putnam, everyone. In the dot-com era, when there were 400 or 500 deals a year, you're barely seeing the institutions, and they're doing so many deals. You have the notice of Wall Street. So, and there were some big deals in that area. When? Oh, I'm sorry. Go ahead.
Yeah, we're a special purpose acquisition company, SPACs. Now, are they coming back? They were pretty popular.
I can speak to SPACs. Okay. So, I'm sorry. Did I answer your question? Sort of.
Well, you went further than my question, but
Then I'll get to SPACs.
the only angle I was also interested in is there any value? Are you going to have more bandwidth, more visibility with those funds if you're in a kind of a low year as opposed to a high year in terms of number of deals? I mean, logic would suggest.
That's what my point is. You get more attention.
Yeah, but you wouldn't. I mean, you would still do the roadshow, nevertheless. In a
Right,
good
but you
year.
get a lot more attention
There's just
because,
more competition.
well, I mean, think about it. I mean, the difference between, say, 33 IPOs and 217 is 33 is less than 1 every week, and 217 is 4 a week. I mean, just think of the attention you're getting. So if you're good, and there were 33 and there were 60, but these guys wanted to go at that time, and they could go at that time. And one of the other things that people have to understand is the IPO is not an exit, okay? It's an exit, but it's not an exit. It is a start to the exit because traditionally, if you own shares in the company, if you're a major shareholder, you're going to be locked up and you cannot sell shares in the IPO. Now, there's obviously exceptions. If Facebook goes out and senior guys there want to sell in that, it's not going to matter, okay? But for most companies, they don't want to see selling shareholders in the IPO because what are you saying to the institutions? This is such a good company, I want out, okay? So it's not an immediate exit event. And so, I don't know, it could be that the guy who went public here is set up now to sell his shares here when the market rebounds. I don't know. Okay, did I now kind of answer your question? SPACs. Wall Street likes trends, okay? And the country likes trends. Remember .com? Remember real estate? And about 2 or 3 years ago, one of the nice trends was something called a SPAC. That's a special purpose acquisition corporation. And what the SPAC was this type of company where it's amazing, but they do it. So it's basically taking a person public. You meet Wall Street people, and for you to do this, you have to have a name. Like you used to be the head of Home Depot, or you were the head of Staples, you're the head of HP. You're the head of HP, and you didn't molest one of the suppliers, we'll say. So you're the head of HP or you're whatever, and then you go to Wall Street and say, actually, a good one would be a consumer one. We'll say Home Depot. You were the head of Home Depot, although that's and he was really bad, and then he destroyed Chrysler. But you were the head of Home Depot and you were good, okay? Nardelli's known for that. Now he's at Cerberus. You're the head of Home Depot, and Wall Street finds you pretty much, or you find Wall Street, and you say, there's a lot of stores around the country, hardware stores, and they can be rolled up. Or there's one big one I want to buy. Technically with the SPAC, it's one big one. And so what you want is, you want $100 million, and you're going to go around the country and you're going to buy a company with that money. It's a blind pool of money for you. Why anyone would invest in that, you need your head examined. But there was one group who invested in SPACs who did well. And nobody knows this. Greg knows because I talked to him. But nobody knows this thing. So most people who invest in SPACs, it was probably the dumbest thing I've ever heard of. Because you're taking one guy and you're giving him $100 million and say buy a company. And probably the most successful one of that was Jamba Juice, although it's not very successful now. But you give this guy a blank check and say, run around and buy a company. And a lot of it didn't work because to be a traditional SPAC, you had to find the company within 18 months or give the money back. And so we had SPACs bid on companies I'm selling, but you also had to go back to the investors and get a vote. So now I'm selling a company, and you come to me and you say you want to buy this company. And I'm auctioning a company, and you want to buy it in your strategic, and you want to buy it in your strategic, and you three are private equity guys wanting to buy the company. Then he comes representing a SPAC. He's got a lot of money. So I look up the prospectus and I see you have 3 months left to invest or you have to give the money back. That's not a great bargaining position, you versus me. But the other problem too is you need a vote. So you say, here's money, I've got the board's approved, let's close the deal. You come in with a bid, you got to go back and get a vote. I don't really want it. And so a lot of these things didn't work. But it's worse because you raised $100 million, but you had to pay 7% to the bankers to do the IPO, and you had to pay some other fees. So on every dollar given to you, you had 92 cents. And then you didn't buy anything, and then you gave 92 cents back to the people. So if you invested in a company where you gave dollars to people and you got 92 cents back in 18 months, can you ever think of that being a successful deal? There's one time it works. There's one time where the SPACs were king. Because you get into the global financial crisis. And the markets during that time went down 60%. Okay? Now, these hedge funds who got in the SPACs and they were ridiculed, everybody's down 60%. You're down 8%. When the money came back, you went to your funds and said, I don't know, you said alpha or beta or whatever they do. They go, I was only down 8% in the recession. And they did that. The hedge funds would say, you should invest with me because see my investments? I was only down 8%. I invested in SPACs, I was only down 8%, and everybody else is down 60%, and they did it. And because of that, SPACs are now starting to make a comeback. But it's tulip bulbs. I just don't get it. Now, there's one more part of SPACs, and I'll answer that.
So they were down 8% because they were sitting in cash mostly? Or?
Remember, to go public, you got to pay the underwriter a 7% fee. Okay? That's the traditional amount you pay an underwriter. So if you raise $100 million, you end up with $93 million. But you also had to pay the lawyers and the accountants and other stuff. So let's say you lost, 8% was lost.
They were sitting in cash.
So you raise $100 million, you're sitting on $92 million. But if everyone else is down 60%, you're the king. You have one eye and everyone else is blind. But there was one more part in SPACs that's important, and I lost my train of thought when he said it. They bought companies. No, it wasn't the amount of money they made. Well, I'll think about it. But there's one more important point of SPACs. No, they didn't have to do. It's individuals. I lost my train of thought when I thought about. Well, I'll think about it. But you get the concept of SPACs, and they're sort of coming back, and then they'll sort of go down and whatever. And I remembered. So I've been doing investment banking for over 25 years. And I've represented private equity funds and venture funds. And I think the real defect of the SPAC when I saw it is this. If you're really, really good, you can raise money from state of Oregon, state of Washington, CalPERS, whatever. And think about it. How many VCs or private equity guys raise funds from institutions? They do it all the time. If you're going to Wall Street and saying raise capital publicly from hedge funds and widows and orphans, you're basically saying you couldn't raise it privately. How good are you? I mean, how many people do you know who've raised private equity funds? A lot of people do it. And that's the normal course of raising your fund. And if no one will give you money, then you find a banker and you raise it from unsophisticated investors and you have a SPAC. That's the other reason why. I mean, Henry Kravis and those guys, they raise it from institutions. So I don't see much in a SPAC. Do you see? SPACs are good if you know a global financial crisis is coming. And that's all I could say for SPACs. Okay. I don't know how much time I want to spend on this because some of this you understand, but why go public? You provide capital to fund growth, creates liquidity opportunities for existing shareholders, remember 6 months later, or some people can trade immediately. The top people are locked up. You do raise your company profile. You facilitate access to capital markets for future capital raising. You strengthen your balance sheet, and there are some employees, senior employees, who want to work for public companies, whether it has the cachet of being public or just the fact that you can get public options. Some employees like going to public companies to get those public options or now restricted stock. What are disadvantages? Regulatory costs and compliance, increased legal exposure, the disclosure of public information, the time commitments, the pressure to meet or exceed quarterly expectations, and the loss of control. What type of profile do public companies have when they approach us and they want to go public? Well, they need to have the potential to be a market leader, a differentiated product offering. They're growing with or faster than their market, depending on how their market's growing. Very important to have an experienced management team. That's true for raising private equity, obviously, too. Attractive story for investors and sustainable competitive advantages. And we like to see top-line growth and cash flow, very good cash flow, stable or upward trending margins, 3 years audited financial statements, conservative accounting policies, formalized accounting and control systems, and strong visibility on forward earnings is maybe the most important here. Okay. Now this is what I'll call a Brad page. I put that together. I'm Brad, so I put that together. And people say to me, Brad, you went through all this stuff, and I kind of get it, but why aren't companies going public now? Is that a fair question? So why don't we discuss that? Well, there's been a lot of changes in the banking industry, especially over the 25 or 26 years I've been in it. You have fewer full-service firms, which and so you have greater difficulty getting research coverage and market making. Remember I told you had the big firms here and then the smaller M&A guys here. The ones in the middle, like Davidson, a lot of them are gone, and they're gone for good. That would be Robertson Stevens, Montgomery, Hambrecht and Quist, Alex Brown, E.F. Hutton, that I'm going really back now, Smith Barney, Solomon Brothers, DLJ, Payne Weber, J.C. Bradford. You even had ones up here. I don't remember what they were. I was in New York. But they're gone. And they're gone because the regulation and the other things have really made it harder and harder to be a full-service firm, and I'll talk about that. But one of the other reasons is there's a narrowing of commissions on trades. The full-service firms like Davidson make a lot of money on their trading desk, and those commissions have come down from 7 or 8 cents to 2 cents. It's just very hard. And those commissions pay the research analysts. Now, in the old days, before Frank Quattrone broke all the laws and we all had to go to jail for him, the research analyst was paid from the investment banker. Okay, well that was good because then the research analyst made money on the deals. You had more research, you had more firms with research, so you could have more public companies. What Frank Quattrone figured out, he would be the tech guy who worked at Morgan Stanley, then Deutsche Bank, and then First Boston, and then almost jail, and now his new firm, is called Catalyst with a Q, is he would go to companies, and he would say that basically you have to do business with us for our research, if you do business with us, our research analysts will put a buy on your stock, or if you let us take you public, the research analyst will say you're great, or if you do the secondary offering with me, the research analyst will put a buy. And that was all funny, and everyone thought that was funny, and then we got to .com. And the big problem with .com is you had all these research analysts saying pets.com was good, and kneehighsocks.com was good, and concrete selling over the web was good, and they were all saying that, and they were all lying, like Henry Blodgett at Merrill. And okay, but a lot of us knew they were lying and they knew they were touting. But when .com hit, and .com changed the industry greatly in terms of public equity, so when all these stock prices fell, and I know there are a lot of lawyers here, I'm a lawyer too, but when the stock prices fell, trial lawyers came in. And trial lawyers sued everybody. And then they had discovery. And then they looked at emails and they saw Henry Blodgett saying, Pets.com is the worst company I've ever seen, but I'll tell people it's good because we want the business. And so there were a lot of lawsuits, and as a result of all of it, now they've overregulated where it's very difficult for me to talk to the research analyst who covers the tech company. And we can't pay the research off the deals. The commissions have narrowed. So firms like Davidson have fewer research analysts. There's fewer firms like Davidson. And it's really the firms like D.A. Davidson, which are like the Robertson Stevens and the Montgomerys and H&Qs, which do a lot of the IPOs. So Morgan Stanley Goldman, they want to IPO GM. Okay, that's good. How many GMs are there in the country? But this nice promising company in Seattle that should go public, there's fewer and fewer of us, the guys in the middle, who could take that public. The other thing that people don't think about a lot is, after .com, what happened to the retail broker it's kind of sad. I know there's retail brokers who are bad and there's retail brokers who are good, but if you advised your client to buy a tech stock, you were sued, no matter what. And my favorite one is Donald Sturm in Colorado. He started Level 3. He is a telecom expert. And he invested in telecom stocks. When they all went down, he sued every brokerage. He goes, I didn't know that these telecom stocks were overvalued. He owned Level 3. And so they're all getting sued. And so what's happened to the retail broker now, it's hard to find a retail broker who will pick stocks anymore. All they do is gather assets. Now, for firms like Davidson, that's kind of okay because they're not sued anymore and they just charge you 1% and they kind of manage your assets. But for an IPO, it's hard because now a company wants to go public. I got to distribute this, okay? And you want to distribute maybe 80% of the shares to institutions and probably 20% to retail. And Davidson can still do this. But for a lot of firms, their brokers, they don't call people up and say, I have Facebook stock anymore. They don't make that call anymore. They manage assets. They don't want to recommend stocks. They don't want to sell stocks. They don't want to touch it because if it goes down, they're sued. And so you lose a lot of the distribution, and it's really occurred. I'm not saying Davidson's perfect. We still can sell retail, but a lot of people, they're retail brokers, they will not pick stocks or recommend stocks anymore. And I'll ask you, when's the last time a retail broker called you up and recommended a stock? Okay, 11 years ago you got that call a lot. But that was distribution for public equity. I'm not going to talk about Sarbanes, you get it, but the regulations of it and the cost of it has really made a lot of public companies not want to go public. And there's a lack of demand now for companies with less than 200 million in market cap because as these funds have gotten more and more money, they don't want to invest in the smaller companies. They don't want these small micro-cap companies. So you've lost a lot of the retail and you've lost a lot of the institutional. And then you have the corporate scandals like options backdating and fraud. I got to say this. If you're Steve Jobs and you do options backdating, you better hope Al Gore's on the board. Because Al Gore said, I didn't see it. And so he's one of the few who didn't have it happen. But for most CEOs, they actually had a board. And there were a lot of guys who got into trouble for options backdating. Or fraud or insider trading. You've heard of insider trading now with Buffett and Sokol and Lubrizol. And so a lot of companies are just saying, I don't want it. And then this was the best. A lot of these companies used to set up what they call cookie jar accounting. GE was the best. When I came up through the business, GE every year would beat their estimates by 1 penny. And you'd say, how can they beat their estimates by 1 penny? What they would do is, I'm sorry? Well, partly, but no, what they do is, they called it the cookie jar. They would take a big loss, and they'd lose, I don't know, it would be in a recession. They're supposed to lose $1 billion, they'd lose $3 billion, because they just wash it all through. Then they've got this reserve out there. And then what they do is a quarter would come and they're going to miss a quarter. They pull money out of the reserve and say, gee, our bad debts aren't as much, or this isn't as bad as I thought. And they're beating by a penny every time. They won't let you do that anymore. But you could do that pre-2000. And so it was great. A lot of these companies would always beat their earnings by a penny, but you're not allowed to do that anymore. I just have a few more slides. So follow-on offering. Oh, this is a very good slide. Am I doing time-wise? Because this is a really good slide. Okay? There is a big, big change in public equity now. And if you're not involved, you wouldn't know, but this is a huge change. What's happened is oh good, the data agrees. Remember how I told you that to do a really good public equity offering, you want to have a 2-week roadshow and meet all the investors for an IPO. For a secondary offering, you're already public, you want to raise more capital, 1 to 1.5 weeks. Okay, and you're meeting the institutions. And when companies come to us and say that they want to raise capital, I say, I want you to do a public equity offering because it allows you to go on a roadshow and tell your story to Fidelity and Putnam and Janus and all those institutions. So one of the good things about the public equity offering is it allowed you to go in front of these big institutional investors and tell your story. And you might say, well, why do they want to tell a story? Well, the CEO has a good story to tell. And no one loves the company as much as the CEO and CFO, so they want to get in front of those investors. And the investors who are busy will see it because they may want to buy into the deal. Make sense? Okay, so we call that a fully marketed deal. Now, why is it in Q2 2009 that only 6% of the public equity offerings did a roadshow? This thing is called an accelerated book build. It has become very big now, though falling off some. Accelerated book build, you come to Davidson and say, I want that money, but I'm not going on a 2-week roadshow. I want that money and I want the deal done in a day and a half. Okay? And I don't care if I see those institutions. I want the money in a day and a half. So that's what happened in 2009. Why? Well, I would say there's 2 reasons. I was going to tell you one reason, but there's actually 2 now that I think about it. The big, big reason is that the market was very volatile during this time. You were having big swings up and down. Remember the flash crash? Okay, so you're having big swings up and down. If you're on a roadshow, hold on. If you're on a roadshow trying to raise equity, and I got to get up here. Oh man, got it. Okay. If you're on a roadshow, see, I'm a computer guy. If you're on a roadshow trying to raise equity, and on the day before pricing, the market crashes, you're not pricing. That is the most embarrassing thing for a public company because the market thinks there was a scandal or there was fraud or there was something like that. And then your stock takes an enormous hit. So if you're in a period where there are huge swings in the market, you go to your underwriter and say, I want to get in front of those guys, but another time. Get me the money. So one is the market has wild fluctuation and volatility, but now that I look at, there's a second reason we want a day and a half. We're in a bad recession here and you need that money in a day and a half. So that could be it too, but that's what this chart shows. Here are just other types of deals called bought deals and registered directs. That's 2 more hours explaining what those are and rights offerings. But just this is a good example showing that during a period like a global financial crisis, people are saying, I need the money and I need it quickly, and they're willing to give up the roadshow. Okay, so some conclusions. It's difficult to predict the stock market right now. Domestic and international concerns continue, which you all know about. But the market, I put this phrase in, has a Teflon-like resilience. I mean, you get all kinds of bad news and the market is still staying pretty high. I think that's because of QE2, really. And so I said, what happens now that the Fed has taken its foot off the gas? QE2 was very, very good for the market. Again, that's quantitative easing too. There's a marked M&A improvement. For the 6th consecutive period, middle market M&A is up on a year-over-year quarterly basis. And valuations are in the 7.5 to 7.8 turn. Strategic M&A is still the driver. As much as I talk about private equity, the strategic companies have a lot of money right now and they're still doing a lot of acquisitions. The private equity rebound is continuing, and that's because the lending, as I showed you, is better. IPO market remains open but selective. Number of offerings has improved. Remember, 60 to 120, but nowhere near the 200 or the 400. And then on follow-on offerings, companies are raising money now more for M&A or for growth opportunities versus paying down TARP or rebuilding balance sheets. So there's a lower pricing discount. And what that means is, if you're going out to the market because you have to rebuild your balance sheet, there's a greater discount, meaning you get a lower price compared to your stock price, which is a long discussion, but I can do it if someone asks. And then I was going to go over some case studies, but I can wait. How am I doing time-wise?
We quarter to,
Or we could do questions.
if you want to cover some of these and some of the cases that you've just been involved
Okay.
with.
Is that okay with everyone? Okay. Everything okay discussion so far? Okay, good. So I'll talk about this one. Thrift Books is a Seattle company, Auburn, Washington, but now I think they're in Seattle. Great company. This was a very tough deal, but it shouldn't have been a tough deal. This company is growing like this. What they do is, and Greg, give me some creative license because I can't do the 2-hour on this. What they do is, because Greg worked on it with me, they go to Goodwill and Salvation Army and they get pallets of books from those places. And those places would normally dump their books. And Thrift Books pays them like 7 cents a pound for the books, which is about 7 cents a book. And then they sell it for $3. The key to Thrift Books, why we like them, is A, they have this supply of books. B, they bring it into their warehouse and they have software which says, this book's good, this book's not good. That's very, very important. And that software differentiates. Some goes to pulp, they get 3 or 4 cents on that. Some goes to Amazon and they get $3 on that. Now, you're looking for a book, The Girl with the Dragon Tattoo, you go to Amazon. Although I heard only in Seattle they shop at Barnes & Noble, not Amazon because of the sales tax. But assume you're not in Seattle and you go to Amazon or barnesandnoble.com, it doesn't matter, but we'll say Amazon. And Girl with Dragon Tattoo is $30, they say, at a retail store, and $21 at Amazon, they say new and used. Used is $3. And you got 8 guys selling used. Thrift Books is 6 or 7 of the 8, okay? You'll see Motor City books, Yankee Clipper books, blah, blah, blah books. It's because of where their warehouses are. And they're just making a fortune doing it because they're getting them at 7 cents and selling them for $3. You'll either see at Amazon or their website $3 for the book and free shipping, or a penny for the book and $2.99 for shipping. So we find this company in the recession, they're growing like this, and we go, wow, this is really good. And then Amazon drops the price of the Kindle in half. And everyone we go to says there won't be books anymore. And we're going, what are you talking about? But our problem became that all the strategic buyers who we normally go to are in trouble. We're not going to Borders. We're not going to Barnes & Noble. We're not going to Powell's Books. They're all in trouble. So we go to the private equity firms, and because they're brilliant, they go, there won't be a book in a year. And it's like, oh. But we were able to find a good private equity firm. We worked really hard on this, and we answered all their questions. They said, what's going to happen to the book industry is what happened to the music industry. And we said, no. Why? What happened to the music industry is, it's not so much that you got the music on the web, is they carved up the CD. Now think about that. Who has ever bought an album in the old days and you only wanted one song? Okay. So the web carved up the CD. The CD is still $14 on the web. It's just you can buy one song. That killed the music industry as much as the distribution. But you can't carve up a book. Books on the Kindle are like $9 or $10. And if they give Kindles away, you can't give away the razor and the razor blade. So we felt paper was still here and books were still here, and they did it, and they paid a very high price. What multiple are we not allowed to say? We got a very high multiple of EBITDA. Okay. Matrix is a software deal I sold in Melbourne, Australia to SunGard. Great deal. Financial software, another hard deal. I went in there in like 07, 08. The company's going like this. They sell software to community banks. Oh, man. 09. But their product helped community banks risk manage their loans. So SunGard, which is a huge multinational company, came in and bought them. Yo Cream is a big ice cream, well, yogurt, frozen yogurt company in Oregon, actually, but they're known for Costco. I think they're all the frozen yogurt in Costco and a lot of the arenas. Limelight is a public equity offering I just did for Limelight. It is a great company. It's like Akamai. People have heard of Akamai, I think, haven't they? They do a content delivery network. Well, here's how you understand what Limelight is. If you get Netflix, it's Limelight. They help do streaming on the internet, okay? It's a great company and it's growing. They create their own private content delivery network, which speeds up rich media and video on the web. This one was a really neat deal. I thought First Interstate was bought. I mean, if you've been around Seattle for a long time, First Interstate was bought. Well, when they were bought by, I think, Wells Fargo, they left a lot of branches in the Rocky Mountains, and there was a First Interstate. So we did $167 million IPO for them. That's a big deal. That's Goldman likes doing $167 million IPOs. Just so you don't think I do more than sell side and public equity, this is a buy side deal I just did. Omega Protein is the leader in the US of fish oil for omega-3 for vitamins. They catch this fish called a menhaden fish. They're totally vertically integrated. They're selling that omega-3 to your vitamin, but they go all the way. They catch the fish, they process the fish. You don't want to see how the sausage is made. But what happens is, in between grinding all these fish, a lot of people say, well, but you know, fish are people, like tuna are people or whatever. They had to diversify. So we helped them buy, we did buy side, we helped them buy Cyvex. Cyvex is like acai berry. They're all the organic stuff that goes into vitamins. So if you go into a vitamin store, it's all the berry stuff. I got to tell this part of the story. So I had to do a fairness opinion for Omega Protein. They are a Houston company, and they are very Texan, and they grind up fish. And we found them Cyvex in California, and they do berries and stuff into vitamins. And I'm going to the board on this one. It's perfect for the company because it allows them still to sell into vitamins, but to diversify away from just marine protein. So I go to the board, and one of the board members says he wanted to see the brochure, and you see the brochure. And the brochure is great because it says stuff like pomegranates. The ancient Romans used to eat pomegranates, and they said their life would double. And this thing gives you fertility, and this thing, and one of the guys goes, it's snake oil. It's because it's all these things, but it's like echinacea, right? It's all these things, and they say what they're going to do, and you don't know, but it's a great company, and it fit Omega Protein really well. Let's see which other ones. Okay. So Tully's, you've heard of. Tully's was in big trouble. They had too much debt, and it was crushing them in the middle of the recession. But they had a wholesale business, which is a K-cup business, which is like gold. We went in there to raise capital or save Tully's, and what happened is people didn't want those restaurants. It's the middle of the recession. They didn't want those coffee shops. And remember, 2 or 3 years ago, Starbucks was going down too. So you sign up these clients, and when the market's crashing and the big buyers are crashing, it's really difficult. So we found a wholesale business in Tully's that was Tully's grocery store coffee and this K-cup business. We sold it to Green Mountain for 16 times EBITDA. That was a huge win for Tully's. Paid off all the debt. If you're a holder at Tully's, you got a dividend, and it propped up the restaurants. Toyota's a client of ours. We sold a telecom provider in Hawaii for them. A, I love telecom, and B, I love Hawaii. So that was a good deal. And the Toyota guys are great. Screen Life is a really interesting company. Seattle again. They make that game Seen It. And CNET, if you ever saw it, is a trivia game. It's like Trivial Pursuit with DVD. So we went into Screen Life, and at the time they were being represented by a New York investment bank, which since you're recording me I can't say, and they were doing a horrible job. And they were trying to sell them to Mattel because this was a board game. So we went into Screen Life and said, well, okay, it's a board game. Where else do you distribute? They go, well, we're on the Xbox now. I go, you're on the Xbox? They go, we're on mobile phones. We're on video on demand Comcast. I go, you're a digital media company. So we stopped talking to Mattel, we went to Viacom, got it sold. Glacier's another bank deal. That's just, we put that up there, that's a big deal. 152 million equity raise, we led. Tyson Chicken, yeah, we like food. We raised $750 million for Tyson Chicken on a convertible debt deal. Last one I'll talk about is VDIC. Let's see if I have any after that. Okay, so the VDIC deal I like talking about. Well, as you can see from these venues, I'm doing deals in Houston and New York and Australia, whatever. And I gave a speech like this in Portland, Oregon. And a CEO came up to me and said that he had a company. And I go, well, what type of company? And it's telemedicine for pets. And I go, I don't really get telemedicine for pets. Sounds good. It turns out that there are very few pet radiologists. And if you love investment banking like I do, you love getting into the company. So there's very few pet radiologists. And the problem is all of these pet clinics, the big equipment people would come to a pet clinic and they would say, you should buy an MRI for your pet clinic because there's 10 pet clinics around. If you have an MRI machine, you'll dominate. So you go, how much is the machine? $1 million. Okay, that's a big expenditure, but the problem is there's not enough pet radiologists. And the normal pet radiologist is driving around Seattle, and he's going to each of these clinics, and maybe you do that scan, and 2 days later he reads that thing, and your client, the dog's dead by then. Your client doesn't want that, and it's hard and he's expensive. That radiologist is making $90,000 or $100,000 a year. So the guy who heads VDIC is actually he actually taught at either Washington or Washington State. He is the leading radiologist for pets in the world, and he's a software designer. So he invented this software, which it makes sense. What happened is the equipment guys aren't selling the equipment because there are not enough radiologists. So he goes to the equipment guys and he goes, you put this little button on the machine, now go back and make the sale. Okay, you're the clinic, now go back and make the sale with the MRI machine, say $1 million. You go, I can't get radiologists, I'm not paying. And I go, no. You scan that dog, then you push this little button, and we will get you a read of that dog or cat within 45 minutes. You go, how can you do that? And I'll toss the first 60 of them free. Bingo. You're selling lots of machines. And how it works is, it's not just the telecom that gets it back to his place, but he invented a software where when that screen pop comes up with the x-ray and you've got a little lump here, you click on that lump and it tells you what the thing is. I could do that. And so he's now going to radiologists and put them in a cubicle, and instead of reading 5 of these a day, they're reading 100 a day. And now he's paying them $250,000 to sit in that cubicle for 8 hours. And he's got radiologists in New Zealand and Europe and whatever. A company's growing like this. It's great. I mean, the clinics are happy. The radiologists are happy. It's just a more efficient way to do this with communications and software. And we took this out to the market. We went to the 2 big pet companies, IDEX, who's the biggest equipment company there in Maine, and VCA, who's the biggest hospital chain, but they also own an equipment company too, and they bid over it. And this was not private equity, this was strategic. And it's like Coke and Pepsi bidding. And we finally sold it to IDEX, and it's great. And I love this deal because that company, since we sold it, it's just going through the roof. And the owner loves it ever. But it was just a great company, but I had to figure it out. I mean, who would have known about pet radiologists? But it was a very good company. And as I said, we auctioned it. Okay.
So What stage is that company at when you sold it? Were they profitable or?
When I met this company, it was too small for me. I can't tell you how much it was, but the revenue was profitable, but the revenue was too small for me. And I didn't want to take it on. But this is in 2008, 2009, where they had that expression, flat is the new up. Because if you remember, everyone was down 40%. So if you were flat, guys would come in and say, I'd say, how are you doing? They'd go, we're flat. That's like up in the recession. And these guys were going 50% in the recession. So what was too small, a year later, fit. I'm not allowed to tell you the size, but it was profitable. But it was growing like this. But what's nice for a banker is this, is lots of people will bid. But if you have, okay, so here'd be an example. If you have someone who's doing database software, I'll just use that again, and Oracle and Microsoft are killing each other to buy that, they probably have good database software, okay? They're experts. And so the two experts in the industry, I placed one call to IDEX and one to VCA. I had the chairman, Bob Anton, who's the CEO of VCA, was calling me every day saying, when can I buy it, when can I buy it? So I go, this has got to be good. And so that's why sometimes it doesn't matter what the revenue is if it's a great model and everyone wants it. But it seemed too small, but when they explained it to me, it made sense. And that's a lot of the business we do is like that. I just want to know what the barriers to entry are and what the growth rate's going to be. And same with this. I mean, this company, Pacific Light Net, had gone through like 2 bankruptcies, not through its own, but because it had bad owners. But they have an undersea cable that connects the islands of Hawaii. And that has value. That just has value. And with Screen Life, if you went to the toy companies, there's 2, Mattel and Hasbro. And they know what they each pay, and they're going to fight you down. But we redefined what it is. We said it's not a board game, it's digital media. And then we go to Viacom and we say, these guys now have access to the Xbox and to cell phones. How'd you like to take SpongeBob and have that access? That's how you get Viacom. So it's positioning. Same with Tully's. Tully's, we try and sell off the restaurants, we're going to get nothing. We found a K-Cup company buried in this thing, we get 16 times cash flow. You got to work in the industry, you got to know what you're doing, you got to know how to position. But good bankers are like management consultants too. We go in there. How much time do we spend going in there and digging through the numbers and cleaning up the numbers and writing the memo?
Measured in months.
Months. We spend months. You know, it's embarrassing to me. I'm sure there's guys in Seattle who are business brokers, and they're like one step below a real estate broker, and they go and say, yeah, I can sell the company. I don't know what they do. We send in a team, and they do the numbers, and they write it up, and they analyze it. I'm sorry, go ahead.
Good question. I don't know how financially it is related, but because you spend so much time understanding this company's business, so you, at the end, it's fabulous deal. So instrument vendors are making more money. Companies making more money. Doctors are making 2.5 times more money.
Mm-hmm.
What about patients, pets in this case?
Okay, I lost the last part.
What about pets? I'm talking about pet
Pets.
owners.
Oh, pet owners.
Patient.
Oh, okay.
I'm talking about our healthcare system, because when we solve healthcare system, we're in this iron triangle.
Good. So
Everybody makes more money.
okay. So do you want to know how pets are doing well here?
Just whether it was even taking into consideration whether
No, it helps
pet
the.
owners will pay less, because pet owners will go and pay as much as it is needed.
One of the reasons I took this on is I made a call or 2 before I took on this deal because it was too small for me,
Okay.
even though it's growing, and I loved it. And I called some people who are smart, I know, and I hate to use the example, but I called a guy at a fund in New York who I know understands stuff like this. And he said, you have to do the deal. And I go, why? He goes, if my dog is sick and my wife is sick, I take the dog in first. He said that. People with pets, they're taking in the cat or the dog first. And, oh, I got to tell you one other thing about this, because this was a great story. So I go, I don't have a pet. I didn't know that. Well, it's better. I go in there and say, okay, but you're doing the radiology and, you got the software, you're clicking on the thing. What if the guy makes a mistake? What about your malpractice insurance? Can I tell you about that, the malpractice insurance?
Yeah.
You make a mistake and you kill the dog, $50.
Oh, yeah.
There's no malpractice insurance. You can't sue over the dog. I mean, but back to the pet, this thing is good for the pets because this makes the market more efficient. Your dog is sick, and now more clinics can have CAT scans and equipment to help the dog. And that dog's a part of your family. You take the dog in, not only is there a better chance of getting the right diagnosis, but it's quicker and it's better so they can do something, and it's cheaper because that's what technology is, right, to everyone?
I do not know, but that's something to look at, the quality of care, because I'm not...
The quality of care is so much better because before you would take the dog in and there'd be a CAT scan, and 2 or 3 days later the radiologist drives up to the clinic and he's tired and he's got a bunch of these and he writes some notes down. You can't read the writing, he gives it to the vet. And here, the thing goes back immediately and you've got a trained radiologist who is reading 200 of these a day, so he's really seeing everything. He's got the best software up there, he responds immediately and you can call him up too, and so you're getting faster, better, cheaper service through technology. But that's what Microsoft did, that's why technology is good. So did that answer the question? Any other questions? Okay. So I hope you got a nice primer on M&A and public equity and deals.